Hello, this is Jerry Peck, Global CEO of Norton Rose Fulbright, and I'm at COP26 in Glasgow, Scotland. And with me today is Tim Ingham, and Tim is with our Climate and Sustainability Initiative in the insurance sector. And for many years, Tim has been actively engaging with colleagues around the world and with the insurance industry about climate change and sustainability and the issues that this raises for the insurance industry. So this is a perfect time to talk to Tim because today is Finance Day at COP. Talk to Tim about the insurance industry. He speaks to clients all around the world and has a lot of information to provide us. So Tim, why don't we start right in? What are the main issues that insurers face as a result of climate change?
Well, yeah, thanks, Jerry. I mean, I think I put these into three categories, really. The first category is insured risks. So understanding and managing climate-related risk across all underwriting portfolios is very important. Obvious one is property, which can be impacted by weather events and changing patterns in weather events. But their insurers have challenges as well because they need to develop models which look forward and anticipate these changes as opposed to using historical data. I think across other lines of business, all can be hit. They can be hit directly or indirectly by changing weather patterns, and of course by the transitioning economy that we're all going through as well. Second category is regulation, I would think. Insurers are regulated. Regulators are concerned about capital. They're concerned about solvency. They want to know that insurers are actually managing that risk across their entire business. So that's underwriting and investments. The UK insurance industry has been subject to the requirement of looking at implementing the TCFD climate financial related risk assessment and reporting for the last couple of years. And as recently as last week, the UK regulator suggested that there's still work to do and that next year they're going to look at the issues of capital associated with that. The third area, Jerry, I think is supporting transition within the economy, if I can mention it that way. Insurers have been asked to promote change. They can do that through products. They can look at reducing the carbon emissions associated with their portfolios of insurance. But they're also large institutional investors. So as well as managing the risk they face from more traditional investments, which could become devalued, become stranded, they also have an opportunity to invest into the transitioning economy and new technology, new infrastructure. So those are the three areas I think that I would focus on.
So one of those areas, Tim, that you mentioned was increased risk from climate change, not just with insuring property, but across many different types of insurance. Which ones really stand out to you?
Oh, Jerry, there are so many that spring to mind, but the one that really stands out for me is directors and officers insurance. What we're expecting to happen in the short term is that all but the smallest businesses are going to be subject to new obligations. So, for example, global standards on climate-related financial exposure assessments and reporting. That's the TCFD recommendations, which are quite well publicized. The IFRS is being supported in a move towards global standards for non-financial reporting, such as sustainability issues. That brings the risk of greenwashing, and we've got quite a few high-profile names with accusations against them at the moment. We've got sustainable financing. We've got new rules on taxonomy. And if I go back to the UK insurance industry, which has just been looking at the climate financial risk assessments and reporting, as I've mentioned, the UK regulator doesn't feel they've got there yet. The TCFD themselves issued an update report last month, actually, which said they're making progress, but there's things to do. So if big insurers with lots of resource are struggling, I can imagine smaller businesses with less resource, with so much regulation coming at them at once. Their directors and officers through their corporate governance are going to struggle with the bandwidth to deal with all of this. So I can anticipate regulatory intervention, shareholder intervention, shareholder derivative claims, and of course investor security claims. And directors are going to be in the firing line, and therefore the insurers of D&O risk need to really adapt to the challenges that provides. So that's the main one that really springs to mind.
And Tim, insurers have their own reputations to consider, and their own, and in some instances, their own investors that they've got to placate and deal with. What are the issues that they face with their own investment portfolios?
Well, insurers have significant assets under investment and to invest in the tens of trillions of US dollars as an industry. They have an opportunity to invest into new innovation and new technology to assist. But some insurers have also made decisions, for example, not to invest into certain industries, coal being one perfect example that's considered to be not appropriate in terms of their stance on sustainability. But I think the insurance industry also understands that there's a need to invest into transition. And of course, transition means that you don't just jump to net zero. There is a transition period. And certain parts of the world, Africa, for example, need a lot of help. So often investments for insurance companies could be challenged because they may not sit comfortably, for example, with management statements in terms of their own sustainability aims and aspirations, or they may even conflict with local taxonomy rules, which that particular insurer is subject to. So there can be a challenge in getting the balance between supporting transition and an insurer not falling foul of its own sustainability aspirations and making sure it doesn't have its own reputation impacted in that way. So I think that's a big issue on the investment side.
In underwriting risks, what role can insurers play in encouraging their clients to make changes that will assist the transition to net zero?
I think it's well known that, you know, all businesses need finance and they need insurance. That's why people like Mark Carney have made it clear they're looking to the financial services sector to promote change. So again, some insurers have already made public statements that they won't insure certain businesses. Again, coal is a perfect example. And that's making quite a significant statement to say that what you do and what you produce isn't appropriate in terms of transitioning. But of course, those industries may then go off and get insurance elsewhere. They may self-insure, so they may still produce CO2 emissions. So another way insurers can look at doing this is to say, we're going to encourage certain industries, certain businesses. So if you set your own targets to improve your own sustainability record, we'll then look to give you better terms, lower premium, broader terms of coverage, and so incentivize change within the economy in that way. Another way is insurance products that can be provided. Property is an example. So if you have a property loss, insurers could say, well, instead of replacing like with like, we will replace with more efficient, more sustainable methods of construction and materials and help in that way. And I think an important one, which really goes to what the insurance industry does, which is insure risk. You know, there's a lot of innovation that's going to be required in terms of moving forward and new technologies if we're going to reach net zero by 2050. And new technology and new innovation really comes with risk in design, risk in construction, risk in operation. I think the insurance industry will really step up as they normally do to help by ensuring the risks that come with that.
So, Tim, does the way that the insurance industry approaches incentivizing their clients to change and work toward a net zero economy have other risks and challenges for insurers?
I think it does, Jerry, to be honest. You know, many insurers have made statements about their individual sustainability targets. What insurers insure produces CO2, and therefore part of a sustainability record for an insurer is the CO2 emissions associated with their insurance portfolio. Many insurers are looking to then reduce the CO2 emissions associated with their portfolios. And of course, if by 2050 insurance portfolios have any CO2 associated with them, then we've failed to reach net zero by that particular target date. So within the insurance industry, what they need to do in terms of addressing that is consider things like, how do you measure the CO2 emissions associated with a particular portfolio of insurance? That involves measurements, it involves metrics which need to be developed, and how do you reach targets? And even if the insurance industry individually approach this, but particularly if they get together to talk about these issues, even where they're making their own individual decisions, that can still raise problems in terms of antitrust, competition law requirements. So to give an example, one group of insurers and reinsurers is the Net Zero Insurance Alliance, which was set up under the United Nations Principles of Sustainable Insurance. And Jerry, I know that you and I are both delighted that at Norton Rose Fulbright, we've been able to assist the NZIA in looking at how they navigate their way around these antitrust and competition law issues. And in that way, we're doing our bit to try and assist the industry with its efforts to contribute towards the transition of the economy to net zero. So avoiding antitrust problems is an important one.
So Tim, there's an awful lot going on within the insurance industry, and there are many challenges, but also a great deal of opportunities, and a number of issues that need to be navigated. And thank you so much for your insight into those issues. It's much appreciated and good to talk to you.
Pleasure talking to you today, Jerry. Thank you.